Hello and welcome to this latest Lunar quarterly update. It's certainly been another interesting quarter in investment markets, with the two similar themes continue to dominate, those being interest rates and inflation. In March, we also had a pickup in volatility driven by the banking sector, which was predominantly started in the US but moved across the pond. So I'm now going to start sharing some slides and we can go through what's been happening over the quarter. So today, what I think is most important to understand is, are we going into another financial crisis? And we'll touch on that. As we mentioned, it's been a period where inflation in the UK particularly has remained sticky, and that's been having an upward pressure on interest rates. And we had a couple of interest rate rises for the Bank of England during the quarter. Against this backdrop, though, and you wouldn't think so when you read the articles in the press, economic growth has been stubbornly strong within the UK, and we'll touch on that as well, and globally for that matter. And we'll just finish on how this impacts investment markets, because we are investment professionals at the end of the day. So the volatility in March was predominantly driven by concerns over the US regional banks, with Silicon Valley Bank and Signature Bank coming under pressure. A bank is like any other institution, and if depositors or customers and depositors in this instance decide to leave, then banks come under pressure. Why has this happened then? Well, there's obviously been an increase in interest rates over the last year or so, and it's made cash deposits in different banks more and more competitive. So banks have to be very aggressive in terms of the deposit rates that they offer to their clients. The second is just to understand these two specific banks where they got very specific clients. So a lot of Silicon Valley Bank had been venture capital, technology orientated and cryptocurrency based depositors, and clearly they've come under more challenges over the last year because those markets have been weaker, and these businesses tend to run through cash a lot quicker. So what happened is all these banks managed to lose some depositors. Credit Suisse was slightly different because it's been more concerns around the mismanagement that's been going on there for a long period of time. And Credit Suisse isn't a new story. Credit Suisse has been in the headlines and had concerns about it for a long time. In fact, Lunar actually sold all their Credit Suisse structured product exposure in October last year because we had concerns back then. So when the banks lose depositors, they then have to realize that and give people their money back. And when doing so, they were forced to sell bonds. Bonds, because interest rates have been increasing and the high levels of inflation, have not been a good place to be invested over the last year. And when they've been selling these bonds, they've been doing so at a loss, realizing that loss, which has put stress on their balance sheets. Silicon Valley Bank attempted to come back to the market to raise equity, but failed to try and shore up that balance sheet. So there's been a number of concerns that have come through. The rise of social media, how quick it is to transfer from bank to bank, has been another catalyst for this. People can panic very quickly and move assets very quickly, and that's certainly had an impact here in terms of these banks. However, that being said, it must be noted that central banks, governments, other institutions have acted very quickly to stop the contagion from the banking sector spreading. We've learned a lot of lessons from 2008. So what's happened? You've seen the US federal regulators confirm all depositors can get their money back, which is clearly very important when people are trying to take their money out and they've got concerns about their ability to get the money out. You've seen a new facility for banks to get, in the US, for banks to get access to capital. So they don't have to sell assets at a loss and put stress on their balance sheet. They can go straight to the Federal Reserve to help fund that. You've seen corporate action. You've seen HSBC buy the UK arm of Silicon Valley Bank for £1. You've seen UBS take over Credit Suisse from the Swiss regulator. That being said, this has highlighted some issues with regards to the US regional banking sector, and that they haven't been subject to the same requirements as the larger banks in the US. So there potentially should be more regulation to come to try and stop this from happening from US regional banks. Now, the question that we asked at the beginning is this 2008? And this is a chart which explains why we don't think that is the case. So without trying to put too much jargon into this presentation, this is an important metric that we look at and other institutions look at, regulators look at, in terms of how strong and secure a bank is. And that's called the core tier 1 capital ratio. And on the right-hand side here, you can see a definition that we've taken from Investopedia, just to explain what that is. Basically, it's a measure of a bank's financial strength. It looks at the core equity to its risk-weighted assets. And on the left-hand side, you can see how the core tier 1 ratio has changed in the US and Europe since 2009 and the banking crisis. The higher the number, the better, the more secure and financially strong the bank is. And you can see that in Europe, it's gone from 8.5% up to 16%. So it's a dramatic increase over the last 15 years or so. The US has not had such a big increase as Europe, but it's still increasing and is a lot stronger than it was 15 years or so ago, going from 10% just to under 14% currently. So banks are a lot better capitalized, they're a lot stronger than where they were, and we need a proper working financial banking system for economies. So it's been impressive the speed at which central banks and governments have been able to tackle these problems. The other big development in the quarter has been the more resilient economic growth that's been coming through. In the UK, we've technically avoided a recession in the final quarter of last year. A recession is technically explained as 2 quarters of negative growth. In the UK, it was slightly positive in the 4th quarter. And when we did this presentation 3 months or so ago, UK growth for 2023 was expected to be down at -1%. It's now forecast to be a little bit better than that, just under -0.5. And this data is from Bloomberg and from economists. NICE have also done an estimate for the economic growth. They did that in the budget, and they actually expect the economy to grow by 0.2% in 2023. That's a clear improvement from the data provided here. The other big development over the last few months has been the reopening of the Chinese economy. And you can see how quickly China's bouncing back from lifting their COVID restrictions and economic growth returning to more normal levels. We've seen this several times within the UK over the last 3 or 4 years. When you have an economy with restrictions, it subdues economic growth. But as restrictions are lifted and people go about returning to their normal life, and doing so quite aggressively, then it can lead to quite a stimulus in terms of economic growth. On the right-hand chart here, you can see purchasing managing indices. What they are is they give us a really good feel for what's going on in the economy right now. And we've got the major nations there, US, Europe, and UK in the respective colours. And you can see right at the end of that chart, there's been a real pickup in terms of activity within the various global economies. And the reason that 50 is dotted there is because anything above 50 is expansion, whereas anything below 50 is contraction. So you can see at the end of last year, we were very much in a contraction environment, but economic growth is starting to accelerate and rebound from very weak levels. The other important point is inflation. We had consumer price index inflation for the UK recently, which remains stubbornly high, above 10%. In other countries, it is falling much faster. So in the US at the moment, it's down to 5% CPI. In Europe, it's at 7%. So the UK is seeing slightly stickier inflation. A lot of that at the moment is to do with energy costs, electricity bills, and gas bills. That is expected to fall towards the end of the year, and natural gas prices have fallen significantly. The other big increase has been servicing costs. So food and alcohol purchases have been a big positive in terms of pushing inflation higher within the UK. A weaker sterling doesn't help that because we import a lot as well, and that's been an added positive to the UK inflation. Outside the UK, though, it does give a lot of kind of less complex decision for central bankers, in that the Federal Reserve will be looking at its data and feeling a lot better with inflation down at 5% than it was at over 8% kind of a year or so ago. So it's providing less pressure to central banks to continue to increase interest rates. In the UK, that seems a little bit harder. Interest rates have been increased over the last year quite significantly. You can see the chart going back for 20 years and how quickly interest rates have been increased. That being said, though, we still think that the Bank of England are closer to the end of this interest rate cycle than the beginning. We are in a very indebted society, whether that be governments, whether that be consumers, And the more they increase interest rates, the more that they're going to slow the economy down. So we do feel that we're at a point now where interest rates are going to start to have a big squeezing effect on the economy if they continue to be increased from these levels. So we would expect interest rate rises to start moderating. And that's sort of what's been coming through. You've seen the Bank of England increase interest rates by 0.25% at the last meeting. The previous meetings before that, it was at 0.5%. So they definitely slowed down their pace of interest rate hikes. It's important that we look at what's going on within market sentiment. On the left-hand side, you've got the Bank of America bull-bear indicator. Markets have been very weak over the last year or so because of the high inflation, because of the interest rate backdrop, because of China, and now because of these banking issues that have been surfaced in Europe and the US. And we've been saying for some time that valuations within companies look very attractive. And that's what's being borne out here from these figures, in that the indicator is still at that very bearish end, which is typically a good time to be buying and investing in markets. You can see after October and the failed mini budget within the UK, that indicator was on its lowest ever level at 0. So the sentiment has improved over the last 6 months, but it's still low and it still looks like a good opportunity for a longer term investor. And the right-hand side, you've got the American data, which looks at how positive or bearish, how bullish or bearish investors are. So are you positive or are you negative? And but a line that's below 0 means that investors are positioned very negatively at the moment. They have very low exposure to equity allocation. And you can see this chart goes all the way back to 1991. And investors are at one of their most bearish stances that they've been over the last 30 years. Which presents a positive outlook looking forward when taking a medium to long-term view. So how have markets performed? This just looks like at equity markets over the last year. It's really been a bit of a mixed bag. The US technology-heavy indices have struggled over the last year, having been the darlings of the COVID crisis, with the NASDAQ down just around 5%, which is the technology line. But you can see how quickly it's recovered, and it's performed very strongly in the first quarter of this year. Europe and the UK lead the way over the last year in terms of the market performance and have performed very strongly, whereas other markets have been extremely volatile. Probably the Hang Seng and the Hong Kong stock market, that has been extremely volatile, which is that purple line. In the middle of last year, it was performing very well. The COVID policy within China meant the market weakened. China's reopening meant that the market was very strong and recovered, but more recently has come under pressure as well. This is one of the charts that we like to show because it shows the importance of diversification and having different exposure to different markets which will perform at different times. So in summary, we are not heading into a financial crisis in our view, and that is due to the strong strength of bank balance sheets. We have been impressed by the speed of both governments and central banks to support the banking system and ensure that these issues are tackled and dealt with very quickly, as well as putting support packages in place to support the banks. Inflation remains stubbornly high, particularly in the UK, but as we showed on that chart, it is expected to fall away towards the end of the year. Interest rates are close to peaking. In our view, they have to be, just because of the debt servicing costs if interest rates continue to move higher. And markets have performed significantly better towards the end of last year, from the October to December period. They started very strongly in January and February. March was a little bit more volatile because of the banking crisis, but in the whole, markets have performed a lot better. Investor confidence remains low despite the rally that you've seen in markets, and you have to be selective in the types of markets you're looking at, but market valuations in our view are still attractive at these levels. Just like to say thank you for listening today. If you have any questions or would like any further information, please don't hesitate to be in touch with a member of the Luna team. Thank you very much.